Welcome back. Thom Hartmann here with you, and on the line with us, I'm super pleased to have Professor Richard Wolff, economist, co-founder of Democracy at Work, author most recently of Capitalism's Crisis Deepens, Essays on the Global Economic Meltdown. You can find all of his writing over at rdwolff.com or democracyatwork.info. You can tweet him at Prof. Wolff, as in Professor Wolff, P-R-O-F-W-O-L-F-F. Professor Richard Wolff, welcome back to the program.
Thank you, Tom. I'm glad to be back again talking with you.
It is always great having you. So big banks are how to say this? What I read this morning in the Times, I believe it was, in the New York Times, how tax bills would reward companies that move money offshore, is that essentially most of the big American banks have set up hundreds, in some cases thousands, of offshore subsidiaries. And this is actually where wealthy people and big corporations are stashing their money. It's in U.S. banks' offshore divisions, at least many of them. And we're looking at $3 trillion, Google, Apple, Pfizer, and General Electric. But the Republicans play this as if that $3 trillion, because it's offshore, is money that's not available to Google and Apple and whatnot. My understanding was that they could say to, say, Wells Fargo, okay, we've got we got $300 billion sitting in your offshore subsidiary in the Caymans, so we don't have to pay taxes on it, but we can't access that money. Would you please loan us $300 billion at 1.5%? And then we'll be able to use that money and make 5, 6, 7% return on investment and pay you back. So they still functionally have access to that money, don't they?
Absolutely. The way that works is Wells Fargo or Citibank or Chase, any of them, use the offshore account with all that money in it as the collateral. So they're perfectly happy to lend at the going interest rate to whatever company has stashed that money abroad, which means that the company has complete access to the money that it has stashed abroad, can do anything that it wants to do or thinks is profitable to do with that borrowed money, and all the while depriving the American government of the taxes they would otherwise have had to pay if they had not gotten the special legislation through, which gives corporations the extraordinary special privilege of paying no taxes whatsoever on money earned abroad and kept abroad in a bank account or any other kind of account overseas. And let me just add, all of the parts of the American economy that help to produce and develop and distribute whatever these companies make or sell, that doesn't seem to matter. Suddenly, they are not a quote-unquote American economy, even though they were born here and they rely on countless supports from the American government, both at the national and at the local level. They are nonetheless able to escape paying their fair share of taxes. And since it's on the order of several $1 trillion, there's one inescapable conclusion, that the claims of both Republicans and Democrats, but particularly the Republicans, over the last 20 years, that there wasn't enough money in the federal government, to give loans to college students who couldn't otherwise go, or to repair our crumbling infrastructure, or for any other worthwhile process. The truth was, the money was there if only these corporations had not been given this special law allowing them literally to escape paying the fair share of taxes they would otherwise have had to pay. So we, all of us, have paid in the way of a constricted American government services simply because they gave this special privilege to these corporations to evade their fair share in that way.
Yeah. Somebody called a little earlier and reminded me of a rant that I did a few years back when there was a change, and I'm sorry that I don't recall the exact details on this, and I'm hoping you do, or maybe I'm wrong on this. But my understanding is that there was a change in the way that banks book basically savings and checking accounts, that they used to be considered liabilities, and so if the bank went bankrupt, the depositors were first in line to be repaid, and it got changed so that they could book them as assets to make the banks look healthier, but also meaning that in the case of a bankruptcy, the banks could actually use your money to bail themselves back out again. Am I remembering that correctly?
Yes, it's actually been given a new name. It's called a bail-in.
That's right.
In order to avoid a bailout. So let me just briefly explain. A bailout is when the bank messes up, makes loans to folks who can't pay back, or otherwise misinvests the money that has been deposited or contributed to the bank. And when the bank falls apart because it can't honor its obligations, having made bad investments, it turns to the government to bail them out. The problem with that, and that's of course what happened back in 2008 on an incredible scale around the world, the anger of the public was, oh my goodness, the government is using our tax money to bail out the failed economic activity of private profit-driven banks. There's something wrong with this picture. And so it became clear to bankers that they could not rely, in the event of future economic downturns, they could not rely on turning to the government as they did back in the 30s and as they did again in 2008. So they came up with a new idea to reconsider the deposits as though they were, in some sense, assets that the bank, as a private enterprise, could take. In other words, what they can now do, and this is true in many countries, including the United States, is under specific circumstances, the bank can access your deposits, consider them their assets, and therefore solve, hopefully temporarily, their failed economic activity by using your money and not having to go to the government to be bailed out.
Amazing.
It is unspeakably outrageous, but look, these days, people like us who are economists and not even necessarily critical are watching one outrage after another pass the paid-for politicians in Washington and covered over with a veneer of Trump tweets pretending it's the opposite of what's actually going on. It's quite a spectacle.
Yeah, it was astonishing to watch Paul Ryan on television this morning just lying through his teeth about this tax bill. We have 60 seconds left, Professor Wolff. What do you think? Is it possible that this tax bill all by itself could precipitate another Great Depression?
Absolutely. There was a story in Bloomberg this morning in which a number of CEOs were interviewed, and they were basically asked the question, if this tax cut goes through and you save a ton of money in taxes, are you going to use it to hire lots more people, which is the promise of jobs that the Republicans and Trump and Ryan and all that keep saying? They smilingly told Bloomberg, which reported, not at all. We expect to use that money to give more dividends to our shareholders, to improve the pay package for our top executives, reminding us all that when you cut taxes on corporations in our society, you don't necessarily get anything that you wanted because you've left all the discretion in the hands of the corporation, which can do what it will with whatever money they don't have to pay in taxes. It's extraordinary.
Yeah, it truly is. And the consequences of it to us as a country are extraordinary as well. Professor Richard Wolff, the economist, co-founder of Democracy at Work, author of Capitalism's Crisis Deepens, Essays on the Global Economic Meltdown, among others, democracyatwork.info, rdwolff.com. Richard, Professor Wolff, thank you so much for being with us today.
My pleasure, Tom, and look forward to doing it again with you soon.
Me too. Me too.